someone came to the other day and they're a bit confused about the difference between what's the repo rate and what is prime. Maybe Kgomotso, explain the difference.
So in the economy, there's what we call the repo rate, or fully expanded, the repurchase rate. The repo rate is the rate at which the central bank or the Reserve Bank lends to commercial entities, or otherwise called commercial banks or pension funds. But it is the rate that the central bank uses to control inflation.
Yeah.
And how it does that is by increasing the repo rate, you're effectively allowing credit extension in the market. There's more liquidity to the banks, and therefore that liquidity passes on to the retail and commercial markets.
Sure.
By decreasing the repo rate, you're effectively taking liquidity out of the market and slowing down the availability of credit to the economy.
Sure.
So it's a mechanism for monetary policy control.
Okay.
So we call it the benchmark backstop lending rate.
Okay.
Prime is essentially the rate at which banks lend to retail clients
like myself,
ourselves,
like you. Yeah.
Exactly, or to other small businesses. However, it's important to remember that it's actually a benchmark rate.
Okay.
So it's not a live commercial rate similar to what we might call JIBAR.
Yeah.
There's a rate in the market which is very important called 3-month JIBAR.
And what's that?
That's essentially the rate at which banks lend or trade money between themselves. So ABSA to ABSA, ABSA to another AAA rated entity, call it Anglo-American, they would all borrow and lend to each other at 3-month JIBAR.
Okay.
Then prime is a spread above repo. Historically, it's been about 3.5% above the repurchase rate, and it's been quite static over the last 20 years. And it's also a spread above 3-month JIBAR.
Okay.
But it's important to remember, even though prime is a rate that banks lend to retail clients, it's really just a benchmark rate. When the banks think about how do they price your loan, they price it off 3-month JIBAR. So it's a spread above 3-month JIBAR.
Yeah.
But when they quote it to you, which is what we all see when we get our home loans, they always quote prime plus, prime minus. Always important to remember, that's not necessarily to say the pricing of that loan is based on prime. It's just a benchmark.
Sure.
Andrew, just for the TUHF clients that are watching or listening to this session. So TUHF, when they are funding these entrepreneurs, they use the prime overdraft rate.
Okay.
So currently, prime is at 7%, but remember that's the base rate that they use. And then they add a margin over and above that.
Sure.
But the basis for calculating your funding is the prime overdraft rate.
Okay.
So it's important for them to realize where prime is.
Yeah.
And at 7%, this is the lowest that has been in the last 40 years.
Absolutely. And I think a very common question that I'm certainly getting, I'm sure you're asking yourself the same question is, so interest rates are low, 7%. And there's great opportunity with that, gents. But the question is, when will interest rates start going up, and how quick will they go up, and will they get back to 9, 10, 11%? And, you know, being a property entrepreneur myself and investing in this market, should I be running my numbers on 7%, or should I be a bit more conservative and say, yes, for the next few years, interest rates maybe 7, 7.5, maybe 8, but should I be running my numbers on 10%? How conservative should we be as investors in this market, Kgomotso?
I think perhaps the first place to start, and I'll go back to what I talked about with 3-month JIBAR. When we're thinking about where interest rates are going to go to in the short term or the medium term, we take our guidance from the Monetary Policy Committee. They meet every 2 months and they set what's happening with the repo rate. But in those speeches, they typically give a fairly detailed guideline as to what they expect to happen in the economy in the short term.
Okay.
For example, in the last meeting, they gave a guideline that even though inflation is at the bottom of the target band, you know, in South Africa, we have a mandate to keep our inflation rate between 3 and 6%.
Yeah.
And I think they're saying that they're estimating that for 2020, it's going to average around 3.2%.
Okay.
So at the bottom of the band. However, they did say that they're expecting that in the third and fourth quarter of 2021, there might be a 25 basis point increase in each quarter. Okay. So basically, interest rates in 2021 might increase by 0.5%.
Okay.
So that's the first guidance we get. The next one is we look at this rate called 3-month JIBAR.
Yeah.
It's a market rate. And remember we said that it's how the banks trade money between each other. And what they then do is they have what they call a market yield curve, which is an estimate of, which effectively is a forward estimate of where interest rates are going to go, but it's based on 3-month JIBAR. So that curve will tell you that basically we're thinking that in a year, this is where the average of those 3-month JIBAR resets will be. And the traders in the bank will call that a 1-year swap.
Yeah.
It's called a swap rate.
Okay.
And likewise, they'll do that for 2 years, you'll have a 2-year swap. They'll do that for 3 years, they call that a 3-year swap. But all that is it's an estimate of where this 3-month JIBAR will reset every quarter for that period.
Interesting.
So it gives you an indication. For example, 3-month JIBAR right now is at 3.34%. So it's actually lower than repo. Something to indicate that. Remember we said 3-month JIBAR is a market rate. So it moves based on what's happening in the market.
Sure.
It's actually at 3.34% now, but I think your 2-year and 3-year swaps should be around 4%.
Okay.
What is that telling us? On average, the market is saying over 2 years, 3-month JIBAR will have increased to around 4%.
Okay.
Which is showing us potentially what could happen to short-term interest rates over that 2-year period, over that 3-year period. So really just to sum it up, we take our guidance from the MPC, economic data, but we also look at the market rates, which is your 3-month JIBAR and your swap rates.